please do. If you have a burning question, get it in, type it in, and it will pop up on my computer screen. And then at the end of the presentation, I will go over all of the questions and make sure that if you type something in, you get an answer to it. All right? So again, pat yourself on the back, congratulate yourself. You are using your quarantine time wisely. You're educating yourself on 1031 exchange and DSTs, which are replacement property solutions. Today's host for your webinar is going to be myself. This is me, Leonard Spoto, and then the handsome guy below me is Toby Costello. He is with Hamilton Zants, which is a partner that we've worked with for about 20 years now, if not, well, almost 20 years. And they are one of the best DST and replacement property providers that we know of. They've been around doing this a long time. So the meat and potatoes of today's webinar is going to be learning about 1031 exchange and the Delaware statutory trust and how they work. Before we get into the meat and potatoes, though, I do want to just give you guys a quick update. All right. We have gotten inundated with questions from clients who are asking, what the heck is going on with the 1031? Have we gotten any 1031 exchange tax relief as part of this overall COVID-19 situation? And I'll tell you right now, as of today, there has been zero guidance from the IRS or the Treasury Department regarding relief for 1031 exchanges. Now, I will tell you that relief is extremely likely. Okay, the IRS gives relief in presidential disaster declarations, and I don't think you could find a disaster declaration that compares to this. But in past disaster declarations, what they have done is they have given exchangers 120 days extensions if you are directly affected by the disaster. So in the case of hurricanes and wildfires, the government has stepped in for 1031 exchanges and said, hey, we're going to give you more time, all right? And in the past, it has been 120 days. We expect at least 120 days extensions when we hear from the IRS, but it could be more, all right? So we are waiting anxiously. Every single real estate organization, from the National Association of Realtors to the CCIM to any type of organization that is directly related to real estate, has written the Treasury Department asking for guidance on what kind of relief we are going to get. So as soon as we know, we will blast out an email to everybody on this webinar and let you know what the relief steps will be. Now, in the meantime, our recommendations are you do your exchange as normal, but when there is relief, you can resubmit your identification letter based on the new days. And then also at day 180, we encourage you to not get a refund on your exchange, all right? Because then you're going to be paying taxes. We say get a refund once you know that you are absolutely certain you're going to pay taxes, or you get more time to go out and buy replacement property, okay? So a lot of fluidity in the market right now. We're not 100% sure exactly what's going to happen with our relief and our extensions and our time frames, but as of right now, do your exchange. If you're in an exchange, like you always have been, with the back of the mind knowledge that you're probably going to get a lot more time and you'll probably be able to resubmit your ID letters if you need to. Okay. Now, Barbara Higgins says there's no sound, so hopefully you guys can hear me. If you can hear me, just let me know. Type in that you can hear me. Barbara, you might be out of luck if you can't hear me. You might need to dial in via the telephone. Your computer speakers maybe aren't working properly. Okay, we can hear you. Perfect. Thank you guys for letting me know. All right, so let's go ahead and get on with today's presentation. And I hope everybody's safe, and I hope everybody's social distancing. We'll get through this, and when we do, those of you who have taken this time to gain knowledge are going to outperform the people who sat around and watched Netflix and ate bonbons. So congratulations. The show is going to start, and you guys are going to be benefits. Now, my company is a 1031 exchange accommodator, and a lot of people say, well, geez, what the heck is that? Well, we are similar to an escrow company, but we specifically exists to structure 1031 exchanges for clients. Now, what does that mean? Well, when a client does an exchange, they're going to sell a property and they have to go out and buy a replacement property, right? But if you're going to do an exchange to defer taxes on that sale, you have to work with a 1031 exchange company. And what we do is we hold the sale proceeds, all right, because you cannot touch the money from the sale of your property. If you touch the money, that is going to be a taxable event. So you have to work with an exchange company. We're going to hold your funds. We're going to prepare all the legal documents that are required to properly document your transaction as a 1031. And then we're going to ensure that you are in compliance with the tax code. Now, we're going to go over all of the compliance issues or a lot of the compliance issues today, but there's just so much. I mean, I've taught 3-4 hour classes on all the nuts and bolts in 1031 exchange, and we're not going to get into the nitty gritty. We're going to go over the issues that affect about 95% of the transactions, okay? And then know that when you work with a company like mine, that we're going to make sure that every I is dotted and every T is crossed, okay? Because that's a big part of our job. As a real estate agent, as an investor, you don't need to know 100% of what the tax code says. Okay, leave that to us, because most of your transactions, you're going to get by with the most basic knowledge. All right, so we're an exchange company. We've been doing this a long time. I've been doing this for about 20 years. I started this company back in 2006. We do about 100 to 150 exchanges every single month. So there is not a situation that you could present to me that I probably haven't already seen before. I'll tell you, the biggest challenge in a 1031 exchange is finding suitable replacement property. Okay, it's not the compliance issues. It's not the time frames and whatnot. It's not understanding those things. It's just finding suitable replacement property. And that's why we do these 1031 exchange webinars with partners like Toby, because Toby's company offers replacement property solutions. And sometimes those solutions are the ideal situation for your client, and sometimes they're a backup. And sometimes they're just not something you want to even be looking at. But what our goal is to give you all of the information that's available to make your 1031 exchange as smooth as possible. Okay. Now, with that said, we've been doing this, like I said, a long time. We've got Toby as a great partner. We want to bring those resources to you. My business partner is also a tax attorney. So we've got a tax attorney on staff. And part of our service is also giving our clients audit support in the event that they have an audit on their 1031 exchange. Now, hopefully you don't ever use that service, but if you do get audited, know that you've got a tax attorney that's going to help you defend the position you took in your 1031 exchange, okay? So our role, we are a facilitator. We get you through the process. We introduce you to people like Toby if you are interested in learning about the replacement property solutions for your 1031 exchange, all right? So that's my company. Now, let's talk 1031. So for those of you who don't know, Section 1031 is simply a piece of the tax code that allows you to defer taxes on the sale of your investment property, okay? Section 1031 of the Internal Revenue Code has been called the single greatest wealth building tool that's available to investors. So if you're a realtor or if you are an investor, you need to know about 1031, because it is going to save you, and very often saves my clients, hundreds of thousands of dollars in potential tax liability. That's money that would have gone to the government that when you do a 1031, you get to keep in your pocket and use to go out and buy bigger and better investments. All right. So Section 1031 is a phenomenal wealth building tool, and it is something that's going to help you accumulate and build wealth faster than if you're just out there paying taxes. So let's talk taxes. Now, I routinely deal with clients who call me up and say, hey, Leonard, you know what? I think I'm just going to pay taxes. They're not really that big of a deal. I heard my tax bill is only going to be 15% on my capital gains. Okay, that is incorrect. Ladies and gentlemen, 15% is the starting point for capital gains taxes. When you are doing a transaction, if you choose to pay taxes, you are going to pay 15% or 20% depending on your income. You're going to have a depreciation recapture tax, which is a tax on the amount of depreciation that you took of 25%. Then you have an additional tax to help fund Medicare, and that is 3.8%. All right. So if you were thinking, well, geez, my client should just pay taxes, it's not that big of a deal, it's only 15%, you are mistaken. All right. You've got all of these taxes to pay at the federal level. And then if you're like me and you're sitting in the state of California, you've got significant California taxes to pay as well. Most states have taxes at the state level. Some don't, right? Notably, Texas doesn't, right? So a lot of people go and they think, well, geez, I'll invest in Texas because I don't have a state tax. Well, if you're a California resident, you pay taxes wherever you sell property. And the California taxes start at 9.3% and go up depending on your income. All right, so it's a graduated tax that can get as high as 12.3%. Now, when we blend all of these taxes together, we're going to pay an effective tax rate of about 33%. So you've got about a third of your gain going to the government if you cash out and pay taxes. So 1/3. And again, ladies and gentlemen, in California, a lot of my clients are, when they crunch the numbers, they're facing $200,000, $300,000, $400,000 worth of potential tax liability. Those are big numbers. Now, the great thing is you potentially don't have to sell. The great thing is that you potentially don't have to pay those taxes. The great thing is that you are selling real estate, and real estate has tremendous tax benefits. The tax benefit that you get depends on the type of real estate that you sell. All right. If you sell an investment property, you can claim the 1031 to defer taxes. If you sell your primary residence, you can claim your homeowner's exemption and avoid taxes. The first $250,000 of gain is exempt on the sale of a primary residence if you are single, and the first $500,000 of gain is exempt on the sale of your home if you are married. All right, so two different pieces of tax law that can save you hundreds of thousands of dollars in taxes. And guess what, ladies and gentlemen? These two tax laws are not mutually exclusive. All right, it's not one or the other. Very often you'll be in a situation where you can use both of these tax laws on the sale of one property. Let me give you an example. You have a 2-unit building. You live in the top and you rent out the bottom. All right. In that situation, you can use both the 1031 exchange and the homeowner's exemption. Walk away from the sale of that 2-unit building and pay zero tax liability. Another situation, you could have a situation where you have a property that you have lived in for 20 years. You move out of the property and you rent it out for 2 years. Well, guess what? You can do a 1031 exchange because at the time of the sale, the property is an investment, but you've also lived in it for 2 of the past 5 years, so you can take the homeowner's exemption as well. That is powerful. Let me go over that again. You've lived in a property for 20 years. You move out. You rent it out for 2 years. At the time of the sale, the property is a rental and can qualify for the 1031 exchange. But you've also lived in the property for 2 of the past 5 years, so you can get your homeowner's exemption. You can take both the homeowner's exemption and the 1031 exchange in this scenario. This is a fantastic opportunity, especially if you bought a property in Beverly Hills for $100,000 20 years ago and you're selling it for $2 or $3 million now, because your tax bill is huge, even with the homeowner's exemption. So move out, convert it to a rental, and then do a 1031 exchange and take the homeowner's exemption. You guys following me? Because that is a huge opportunity. Now, if you're going to take advantage of these opportunities, you're going to have to understand how the 1031 exchange works. So let's talk about how the 1031 works. 4 basic requirements for a 1031 exchange. Number 1, the properties involved in a 1031 exchange must qualify. Now, how does a property qualify for 1031? Pretty simple. It has to be used for trade or business or for investment, and properties involved in a 1031 exchange must be like kind. Now, this like kind requirement here is a source of confusion for a lot of my investors. They say to me, well, geez, Leonard, if I sell a rental home, can I buy an apartment building or do I have to buy another rental home? So that's like kind. Well, ladies and gentlemen, like kind is any type of investment property. So you could sell land and you could exchange into a rental home. You could sell the rental home, you can exchange into an apartment building. You can sell your apartment building and buy 2% of a Delaware statutory trust where Toby's company manages everything. Okay, so there's a lot of opportunity for you, ladies and gentlemen. You could go into different types of real estate. And the great thing, too, is you can go into different geographies. Right now, I have a lot of people who own rental homes in California, and they are freaking out because they're saying, geez, all this rent control, what do I do? Well, they do a 1031 exchange into Texas or into Ohio where there's no rent control. You can do that, all right, because any type of real estate anywhere in the country will qualify. Now, of course, there's a couple exceptions. You cannot go outside of the United States. So you can't sell in California and buy in Mexico. You can't sell in New York and buy in Canada. That doesn't work. And also, ladies and gentlemen, inventory is not exchangeable. Now, when most people think of inventory, they think, well, geez, you know, the grocer has bread on the shelves. That's inventory, right? Well, it is. But in the real estate world, inventory is generally considered quick flips and development deals. And the tax code specifically prohibits inventory from being exchanged. So if you are a flipper or a developer, you do not qualify for 1031 exchange. So if you're a flipper and you're a developer and you want to do an exchange, what do? Well, instead of flipping the property, what I want you to do is once you're done improving it or building it, I want you to put a tenant in the property and season that tenant in the property for 1 to 2 years. I want you to report the rental income on your taxes for 2 years. I want you to depreciate the property, and I want you to save all of your lease agreements. You do that, and if you're audited, you've got a very compelling story to tell the auditor that, hey, this was truly an investment. Now, why do I say 1 to 2 years? Why don't I say exactly 2 years? Well, because the government does not give us a specific number of weeks or months or years that the property has to be rented out. The time of rental is one factor that they will consider, but they also consider your intent. All right? And intent is, well, geez, what did you intend to do with the property when you bought it? All right? And you want to make it look and smell like an investment as much as possible. Okay? So if you use the property personally, that's not good. I want you to limit your personal use on any 1031 exchange property. How much personal use can you have on the property? Well, here's the rule. You get 14 days per year personal use, or 10% of the amount of time the property was rented. So if you rented the property out for 30 days, you can either have 14 or 3. If you rented out the property for 300 days, you can either use it personally for 14 or 30, whichever is larger. But beyond that, I don't want to see you using the property, okay? Because it needs to be an investment. Too much personal use can disqualify the property from being an investment. Does that make sense? Okay. So rule number 1, make sure your properties qualify. Rule number 2, when you do your 1031 exchange, If you don't want to pay taxes, I need you to remember two things. Number one, reinvest all of your cash. And number two, purchase property equal or greater in value. If you are in contract to sell a property for $1.1 million and you pay $100,000 in commissions, your net sales price is $1 million, and that's the value that you need to replace in your 1031 exchange. You need to use all of the cash that comes from the sale of the property as a down payment, and you need to buy equal or greater to what you sold. All right? And that's, again, after commission and closing costs. That makes sense. A lot of people think, well, geez, Leonard, I thought all I had to do was reinvest my profit. That is incorrect. Oh, geez, Leonard, all I thought I had to do was reinvest my cash. That is incorrect. I need you to replace the net sale price and use all of your cash as a down payment. Now, that is going to mean that most likely, if you had debt on the property over here that you're selling, you're going to need to get a new loan on the property you're buying. Some exchange companies will tell you the rule is you have to replace your debt. Have you guys heard that? That is actually incorrect because you can always contribute additional cash to buy the property. Maybe you don't qualify for a loan anymore because you had some bankruptcies, but you've got a ton of cash in your pocket. Okay, that's fine. You sold for a net sales price of $1 million. You have $600,000 coming out for a down payment, and you add $400,000 from your piggy bank, and you buy this property all cash. That's fine. That works. Some people can't qualify for loans anymore because now they're retired, right? So if they want to add cash, that's fine. So you could sell for $1 million, you could buy for $1 million. But what happens if you don't go equal or greater? What happens if you sell for $1 million and you trade down in value? Well, it doesn't negate the entire tax benefit. What happens is the trade down difference of $50,000 in this example is going to be taxed. All right, so you can do a partial exchange. You can have some tax deferral and you can pay some taxes. You've got $50,000 left over. You don't want to invest it. That's fine. Take it and pay taxes on it. All right. So yes, you can do partial exchanges. You can also do multi-property exchanges. Let's say you want to sell one building for $1 million and you want to buy two, one for $500,000 and another for $600,000. Does that work? Absolutely. So you can do multi-property exchanges. You could do partial exchanges. You have a lot of flexibility. But remember this, if you don't want to pay taxes, you need to reinvest all of your cash and purchase property equal or greater in value. Now, Mark says, well, if I have a loan, can I just pay it off beforehand? Sure, absolutely. Can I use my 1031 exchange dollars to improve the new property? You can. It requires what's called a construction improvement exchange. It's a lot more difficult, and if you're interested in that, I can send you information about that. So the technical answer is yes, you can use money to improve the new property, but it does require a more difficult type of exchange. Good question, though. Okay, we're getting a lot of questions piling in, so I'm going to save some of these for afterwards because I do want to give Toby some time to talk about his products. So let's move on to requirement number 3 in the 1031. Now, in a normal world where we don't have coronavirus locking us in our houses, you're going to have a strict time frame to get your exchange done. All right? You have 180 days from the day you close escrow to go out and buy replacement property. 6 months, 180 days. And in normal times, there's no extensions. Okay. The government, however, as I mentioned at the very beginning of the presentation, does provide extensions to this time frame. However, when there are national emergencies and presidential disaster declarations, and ladies and gentlemen, we are in the middle of one right now. If you logged on late to the presentation, know this: we will likely get an extension of at least 120 days on this 1031 exchange time frame. Okay, that's what they've given in the past. There's no guarantee, but if I'm a betting man, I'm going to say you're going to get at least 120 days more to do your exchange due to the coronavirus. And as soon as we have the details of the extension and the relief that the government's giving for 1031, we will let you know. All right? But in normal times, you have 180 days, and you have to do what on day 45? You have to identify what you're thinking about buying. Day 45 is very important. You need to tell the government what you're thinking about buying, and you need to do it in writing. And unfortunately, ladies and gentlemen, you can't just go to the MLS and print out 30 different properties and say, okay, I'm going to buy one of these 30. You got to fill out your identification letter according to the identification rules. All right? There are two rules in which that you can follow. You can use the 3-property rule or the 200% rule. This is what an identification letter looks like. You're going to say, okay, I'm going to use the 3-property rule. And then when you choose that rule, you're going to identify 3 properties. All right? Your first property might be 123 Main Street. You got a property on Fillmore Street. You've got a property on Union. Those are your 3 properties. On day 45, you are then locked into those properties, and you have to buy something from that list. After day 45, you cannot make modifications to the list. Unless, of course, we get a disaster declaration and the government says we get more time. All right? But in a normal situation, if your property number 1 gets sold to someone else on day 46, you can't replace it. Property number 2 burns to the ground on day 47. You can't replace it. You've got to buy the 3rd property on your list, and if you don't have a valid exchange. All right? It's not the end of the world. Just pay taxes. Now, again, because of the coronavirus, we're probably going to get more time for all of our exchanges. All right? So if I'm an exchanger, this is probably one of the best times to actually do an exchange, because you're going to probably get almost a year, if not more, to identify and to actually purchase and close. But the 3-property rule gives you 3 properties in normal times. And if you're thinking of going out and buying more than 3 properties, you're going to have to identify using the 200% rule. All right? The 200% rule does not limit the number of properties. You can pick as many as you want. The 200% rule, however, limits the value of the replacement properties, and that value limit is 200% of what you sold. So if you sold for $1 million, you can identify $2 million worth of real estate. If you sold for $3 million, you can identify $6 million worth of real estate. Most of my clients will use the 3-property rule because most clients sell one, buy one. However, some of my clients sell for $2 million in San Jose, and they go to Texas and they buy half the town or 10 properties. All right. And if you're going to buy 4, 5, 10 properties, you're going to have to identify using the 200% rule. Now, ladies and gentlemen, 99% or 95% of every single deal you work on, what I just told you is going to be enough to get you through the 1031 exchange process. All right. You need to know what properties qualify. You need to know how to fully defer your taxes. You're going to need to pay very special attention to the time frame and any extensions that we get. And then you're going to have to identify. I will tell you that the single most challenging part of the 1031 exchange process is finding suitable replacement property in whatever time frame you have. All right. So in order to do that, what I'm going to recommend you do is that you use the resources and the options that are available to you. And one of those resources may be Toby Costello. All right. Toby works for a company that sells slices of very large buildings. You could go out and you could own 2% of a $50 million building. All right. So if you're going to work with an investor who's going to do an exchange, wouldn't it be nice to list their property and already be able to show them alternatives that they could invest in right off the bat? You got your listing presentation. And part of that listing presentation is, hey, you might want to consider a DST with Hamilton Zants because I can get you into that in 2 weeks without any hassle. All right. So it may be an option your clients consider. So Toby is someone that you, excuse me, Toby is someone you should have on your team as a resource because he's got readily available institutional grade properties that you can invest in. And with that, I'm going to go ahead and turn it over to Toby. And I realize that we have a lot of questions that have popped up, but I'm going to answer those questions at the end of Toby's presentation. And Toby, we're going to get you set up here. I'm going to pass the microphone over to you right now. So if you can accept, and then if you could unmute your phone so we can all hear you, we're going to hear from you right now, Toby.
Perfect. Cool. Can you hear me okay?
Yep, absolutely.
All right, super. Well, Leonard, thank you very much for the really warm intro. So again, I'm Toby Costello. I work at Hamilton Zants. We're based in San Francisco. If you notice our address, that's on Graham Street. We're right in the Presidio. So I figure I'll talk for maybe 5 or 10 minutes about what my role is and what we do and how we work with investors and people doing 1031 exchanges. And then I'll kind of cut it short there and we'll open it up for questions. So I hope everyone's staying safe and kind of sheltering in place here. So quick disclaimer, we operate under an exemption through the Securities and Exchange Commission. There's limits to what I can talk about here, so I'll just speak conceptually about what we do. I can talk about past offerings for future ones that we're going to buy or planning to buy that would require a follow-up conversation as a one-off. So if we get into the weeds on that stuff, it's not because I'm being evasive, it's for legal reasons. So again, we'll talk about an intro to what we do as a firm, different ways to invest with us. We're big believers in multifamily investing, and we'll talk about some reasons why, and then again, open it up for question and answer. So there's a lot of words here. Leonard's better at using that highlighter, but that's like next level, and I don't know if I'm quite there for presenting just yet. But so as a company, I always tell the story about the first property that we ever bought because it is still indicative of how we operate today. So rewind your clocks, go back to 2001. Mark Hamilton and Tony Zants, they were two buddies. They found a 16-unit apartment building in Oakland that they wanted to buy together. So they put in some of their money, just cash that they had in their bank accounts, and some friends and family came together with some cash. And at that time, Tony Zants' father happened to be in an active 1031 exchange. And so he exchanged into that property as well. And so you had a combination of people investing cash and then one person putting in a lump sum for an exchange amount. They came together at the closing. They bought the property, fixed it up, paid some cash flow to investors. They eventually sold that property, did a 1031 exchange, and that's what we've been doing ever since. And so I tell that story because that's still how we operate today. We still have people that invest cash in our properties, but the bulk of the capital comes from people that are doing 1031 exchanges. If you fast forward to today, as of right now, we own 86 properties. That's just over 21,000 apartment units in 15 different states all across the country. And so what that means is we have done a lot of investing with our investors. But again, the bulk of that has been through people doing 1031 exchanges. We're about a 55-person company, again, based in the Presidio. We are not a REIT. We're not a fund. Really at its core, both the ownership structures that we will utilize. One is TIC, tenancy in common, and the other is a DST, a Delaware Statutory Trust. And those are just two different ways to hold ownership in real estate. And we'll get into the weeds on some of that here in a minute. But I think there's some interesting things to call out here. We invest in every single property that we buy. So this isn't something that we're saying, hey, you go invest in it and we're going to keep our money over here on the sideline. Mark Hamilton, Tony Zans, Kurt Hal Cooper, who's the third partner, and all the employees combined will be at least 5% of the equity in every property that we buy. So we are believers, and if you put all of us together, we are our biggest investor in our properties as employees and as the principals that own the company. And then the other thing is, I'm not on commission. No one in the company is. We don't pay commissions, unfortunately, for brokers. But to the extent we can be a resource for brokers, or for you and your clients, or for you if you're an investor, that's very much what my role is to educate, just like Leonard, and be a resource. And we found that builds goodwill and it's helped us grow our business. So graphically, we are in 15 different states. We are truly coast on the coast. There's a big vacant spot on the West Coast. We really like a lot of things about California. Rent control and prices are two things that are really difficult for us to stomach right now in California. So we no longer own in California. If you look at this map from, excuse me, there's nothing to the east of Texas on this map. But we bought a 700 unit apartment building in Atlanta for the Eastern time zone. And what brought us there was, it was a seller. We had a lot, when we buy a new property,
you're talk about the just job. A little bit here.
Yes. Oh, okay.
Toby,
sorry,
your
I'll
phone
put the
is
phone a little bit closer.
Yeah.
Working from home has. Okay. Can you hear me now? Is that any better? Hello, Leonard?
Yep, we can hear you better now.
Okay, good. So the thing that will be common for us when we go to a new market is jobs. We want to make sure that there's good jobs. Isn't any of these buildings have anybody? Are there tenants there that have good jobs and they want to rent these apartments? And then there'll be sellers that we have familiarity with. That property that we bought in Atlanta was through a group called Aimco, and our number one seller, for one buyer. We bought over 30 properties from them. And so there's going to be a reason for us to go somewhere. It's going to start with jobs. Will be our first pull, and then there's got to be some sort of familiarity, whether it's a seller we've worked with or something different. But again, we take our role in this very, very seriously. And Leonard and I were talking about this earlier in relation to where we are with COVID-19, and we take it seriously. We, like I said, we own 21,000 apartment units across the country, and people. Those are real people, right? And our sister company, Mission Rock Residential, that does all of our property management, they've got over 750 employees. And so that's a really, really large number of people. And we got to make sure we're taking care of them, right? By providing good health. It's where tenants and employees want to be. And so, where it relates to COVID-19 and where we are right now is we know that there's going to be some tough times ahead of us, and we're going to work with our tenants to make sure that they stay in their home. We've been through a recession prior to this and market recessions before that. And what we have found is companies that do what we do, which is work with the tenants, make sure you provide good housing for them, work with them to keep them in their homes and keep your occupancy level good at the property level. You're going to come out of this, whatever this is, better than a lot of other people. If you're just, our portfolio, this is a little bit outdated, but I think some numbers to call out here. People invest with us because, they're selling something usually in the Bay Area where they have a very, very low basis. And they want to know kind of what our priorities are. And so our number one priority when we buy a property, capital, right? So if you give us $1, we give you at least $1 back. Second, is going to be stable, distributable cash flow from the real estate. And so our average cash on cash return is across our portfolio. And then the third is time of sale. We will hold these. Our historic average has been about 6 years. Looking forward, that number is going to increase and be kind of 7 to 10 years. And so if you take those three things in order, preservation of capital, stable cash flow, our priorities when we buy it. So this is long-term, institutional grade, generational type real estate that we want to be acquiring. So there's two forms of ownership that we will use. One is tenancy in common. The next is Delaware Statutory Trust, or DST. So I'll start with TIC because I think it's what a lot of people are familiar with. TIC, it's no different than two buddies. Leonard and I, we want to go buy a property together. Leonard puts in $1 of cash. I put in $1 of cash. He and I go to the bank. We apply for a loan. They give us one loan on that property. Leonard and I have an agreement between each other, the TIC agreement, that outlines the rules of the road and how we're going to make up and break up. And then he and I go buy that real estate together. And then he and I will share in the ups and downs proportionate to our ownership interest. In this case, it's 50-50, right? If we have a good year, we split it 50-50. If we have a bad year, we also split that 50-50. If it needs a new roof, we split it 50-50. So this is what we've used more times than not, is tenancy in common. And our minimum for us to do it is $1 million. And so the reason being, we're going to get a loan. You're going to get underwritten. You or your client will get underwritten by the lender. And that takes a lot of time. And so Fannie Mae and Freddie Mac, those are the groups that we will get a loan from. We're a preferred borrower, one of the top 40 borrowers in the country with both of those groups. We'll get a loan from them. It takes time to get underwritten. They limit us to only 10 TICs, which can be on title. You or your clients would be one of those TICs. And so we'll take, 7 to 10 individual TIC owners. They'll all get a fractional interest of real estate. We'll get one loan. They get obviously their proportion of that as well. And they own the real estate. It works from an exchange standpoint. The barrier to entry for us is $1 million, which is pretty high. But what you get in return is you own real estate and you don't have the management headache, right? We handle the asset management. We handle the property management. We deal with tenants and toilets and stuff that a lot of people don't want to deal with. And so our typical TIC investor is someone that owns 10 units in the Mission. He or she are in their 60s to 70s. They like real estate. They really are big believers in it, but they don't want to deal with the day-to-day headache, and they want to do more travel and see their grandkids. That's our typical exchange investor for a TIC. So that's TIC in a nutshell. I think a lot of folks, especially on this phone call, probably know what that is. So I'll move on to the next one. Delaware Statutory Trust. We'll call it DST, just so it's less of a mouthful for this. Again, people make it more complicated than it really needs to be, and it can be. But at its core, it's just another way to hold ownership in real estate. In a TIC, Leonard and I both kick in $1, and we go and buy the property together. The way that a DST will work at its simplest is a company like Hamilton Zands will find a piece of real estate. We will get one loan for all of the real estate. We will write one check for all of the equity, and we will buy the real estate, right? And then we will turn around and we'll go to investors like you or me and say, we've got this property, we just bought it, would you like to 1031 exchange into it? And so you're actually able to exchange into property which has already been purchased. And what you receive in exchange is you exchange in and you get beneficial interest in a trust, right? The trust owns the property. You get a beneficial fractional portion of that trust, and you can do a 1031 exchange. And so the barrier to entry is usually much, much lower on DSTs from a financial standpoint, whereas in TIC, groups like us are limited to only 10 TICs, which can be on title. In a DST, there's no limit to the number of people who can be on title. So our minimum for a DST with us is $100,000. And so, again, you get all the same benefits. We deal with the management. We deal with the headache. You're investing in large, out-of-state, institutional grade turnkey real estate. But the barrier to entry is lower from a financial standpoint. So our typical DST investor usually meets one of two. They're kind of one of two camps. One is they sold a smaller property, right? They have $200,000 or $300,000 in an exchange account. That doesn't get you there on a TIC, so they can do a DST with us. The other would be people that put a large premium on diversification. They have $1 million, but they want to split it 3 different ways and put it into 3 different properties. You can do that with the DST. It may not all be with us, depending on what we have in our pipeline, but those are usually the 2 camps that people fall into, and it really is driven by the amount in the exchange account. Leonard, maybe I'll stop there. Does that make sense, or do you want me to go delve deeper into any of the DST?
Yeah, I think it's great. I think one of the things that people ask a lot to me and to guys like you is, well, the loan situation. We have a lot of clients who maybe can't qualify for a loan because they're retired, things like that. I think one of the strategic benefits of the DST is that they do not have to qualify for the loan, and it's non-recourse funding. Is that correct?
That is correct. Yeah. So going back to, a lot of this goes back to when we first buy the property. When we buy the property, let's say, just because the math's easy for me, we're going to get a 50% loan to value loan on the property. So that means every dollar that you bring of equity, you will also be allocated $1 of debt, right? And that's not a loan. You don't have to go down to Chase and apply for the loan. The only requirement is that you are an accredited investor, which is a defined term. It means you as an individual, you've got $1 million of investable assets exclusive of your primary residence. Or as an individual, you've made $200,000 or more in the last 2 tax years, or $300,000 for a married couple. And so you don't have to qualify for a loan the same way you would if you were, most of our investors are retired or very soon to be. So it's a pretty plug and play solution.
So in the main benefit that my clients, when I have a client that is a good candidate for an exchange, it's typically someone who just says to me, well, I don't know what to buy because I don't want to have to manage these problems anymore, but my problem is I don't want to pay my taxes. And for me, that is a big kind of light bulb that goes off and says, well, geez, you should go talk to Toby because you don't have to manage anything and you still get to own real estate. The next question they ask me, though, is, well, geez, how much does it cost for that? Because nothing in life is free, right? Sure. So you have fees, right, that you're going to charge. And can you kind of go over those and how they relate to kind of, what you guys do?
Absolutely. So not all, yes. So on a TIC, I'll go back a slide. On a TIC, when we buy a piece of real estate, the most apparent fee will be we get paid an acquisition fee to buy the real estate. This is on top of any sales commission we would pay a broker, et cetera. That's usually 1.5% to 2% of the purchase price. So we get paid an acquisition fee when we buy a piece of real estate. That is the same. I switched slides here. That's the same as a Delaware statutory trust. We will get paid an acquisition fee and that's our risk for putting the whole thing together. And then beyond that, there can be additional layers of fees on the DST. I described the most straightforward, which is we find the real estate, we buy the whole thing with one loan, just Hamilton Zand. The other more complicated way is, and this is where fees can get baked in, and this is where knowing the right questions to ask and the right groups to engage with is really, really important. So we get paid a fee to acquire the real estate. It has happened in the past. We have done a joint venture with a group called Cantor Fitzgerald. They're out of New York. They will actually write a check for all of the equity. And then Cantor Fitzgerald gets a fee. And then Cantor Fitzgerald will then sell out their equity stake through a network of broker dealers. These are people that are like registered investment advisors, stockbrokers, et cetera. And those folks also get paid a fee. And so that's why on here, if you see on the right-hand side, it says some of the cons of doing a DST is that the fees can be, if you add them all up, they can be pretty high. But that's why it depends. There's a big range there. 10 to 20% is a big, big range. Some of them are even lower than that. And that's why knowing where to look, knowing the questions to ask, and then also being really, really, kind of cautious about what those fees are, because 10% sounds like a lot, 20% sounds like a lot, but it is less than the 33% that you would potentially pay in taxes. And so that's not a reason to do it or not to do it, but I think it's a good lesson in just going in with eyes wide open.
Yeah, and I think you have to kind of equate it like a mutual fund, right? If you're going to invest in the stock market on your own, you can do it really cheap, but if you're going to have someone manage those investments for you, that you got to pay. I think one of the other things, and I think someone asked me about some of the cons. Suzanne was asking, well, geez, what are the cons? And there's a couple cons that you've put up here for everybody to see, Toby. But I think one of the big things that a lot of my investors ask is, well, number one, how do I get out of it? And number two, when I get out of it, can I exchange again? So I'll let you answer both those questions.
Yeah. So in both of these, in the tenancy in common, you'll see lack of liquidity. In Delaware statutory trust, you'll see lack of liquidity. So if you exchange in, plan on your money being in those vehicles for the length of that whole period. There are mechanisms to get your money out. They are not easy. Sometimes it comes at a penalty. Every sponsor, we are a sponsor in this, Hamilton Zands is a sponsor in this scenario. We'll do it slightly differently, but there's ways to get it out, but it's not easy. So I would plan on your money being in that deal for the length of it. But I will say, once you're in, and it's 7 years from now, we sell the real estate, you'll have the option of doing an exchange. You're not tied to us. You can do an exchange. You can go buy Walgreens. You can cash out. You can do whatever you want with that money. So you can exchange in and you can exchange out. But it is highly illiquid on the interim. And that's not a reason not to do it, but it's just again, eyes wide open kind of thing.
And then when you guys are putting a deal together, an investor, after the fees are considered, can typically count on what kind of return? What are you guys seeing in the marketplace right now with some of your offerings?
Yeah, good question. So if you looked at all 86 properties that we own, they're just north of 6% cash on cash. So and then most of the properties that we're buying are starting at about 5 to 5.5% cash on cash. And that's calculated on your invested equity. So if you have, $100,000 with us, you're going to get $5,000 a year on that amount. And so we calculate that annually. We pay it monthly. So a typical property, we buy it. We pay nothing to investors for the first 3 months just to make sure we build up a stable amount of reserves and get our arms around the real estate. And then we begin paying distributions from the cash flow at the property, starting in month number 5 from the income in month number 4. And then it goes out monthly from there, obviously, to the extent that there's, the property can withstand it. It's important to keep in mind, I keep going back to the simple example of this is like Leonard and I going and buying a building together. It really is that, right? And if our money's in one building, with that building, what it really is it's a business. And so there's going to be ups and downs. And so that distribution can fluctuate over time, but most of the time it stays at about where it is. And sometimes it stair steps up a little bit.
Okay. A couple other questions. So Christian Reyes asked, how do you access your existing offerings? Do you go directly to you, Toby, or how do they see what's available from your company?
Good question. This goes back to that big dirty disclaimer at the beginning. I cannot advertise to people that I don't have a pre-existing relationship with. And so if you think that this is of interest to you or your client, or you want to learn more, please reach out to me. And this isn't self-serving. It really is a legal thing. And I can talk to you about what we've had in the past, and we can talk about our pipeline as well. Current investors of ours, we have an online portal. They'll see all of the current and upcoming offerings that we have. But we, as a company, we will buy anywhere from 10 to 15 properties per year. We've purchased 3 here. And so, all of what's going on in the world notwithstanding, we'll probably buy, half a dozen more before the end of the year. And so I think if it sounds like you've got something coming, or it may be of interest to you or one of your clients, please reach out and we can have that conversation.
Okay, and then last question for Tony, then I'm going to talk about a couple other things. So this is from Antonia. She says, well, what if I don't own real estate and I don't want to do an exchange, but I want to take some cash out of the stock market and invest with you guys? Is that possible?
Definitely. Yeah. And so again, that first property that we bought, it was Mark and Tony, and they put in some money. We will, whenever we buy a property, we'll have, there'll usually be one person that does a big, large 1031 exchange, and then we'll have another silo, and that's a partnership. It's a multi-member LLC that owns the real estate, and that's where, if you have, most of our offerings have a $50,000 minimum, but you can invest $50,000 and own a piece of a $50 million piece of real estate, and you get all the same benefits from a cash flow perspective as the person that invested $1 million does. So yes, it's definitely available. And then same answer as far as seeing pipeline is give me a call and we can talk about it.
Okay, perfect. Thanks, Toby. I'm going to go ahead and take over the controls here because we've got about a minute left. You've got Toby's information on the screen. If you guys take a look at your computer screen, again, Toby's here. I'll highlight his phone number for you guys. He's got an email address down there, and they've got a website. So check them out. You can use Toby as a resource. He's a fantastic guy, and their company, as I mentioned, we've known them for many, many years, and they're one of the best in the industry. So happy to have Toby on, and thank you for your time, Toby. We've got a bunch of questions here that I'm going to chug through. It is 2 o'clock now. 3 o'clock. So if you do need to run because you've got to go sit on the couch and watch Netflix during quarantine, feel free to bail out on us. But if you want to stick around and ask questions and listen to some of these answers, feel free. So I'm going to start here at the top, and I might toggle around to some slides to illustrate my point. But for right now, I'm going to go ahead and answer Arif's question. Arif asked about the net sales price, and we've had a few questions about the net sale price. Okay, so I'm going to actually try to go over to a slide here and show you guys an example of how to calculate what the net sales price is. So remember, when you're talking about gain and all those things, what we want to look at is the actual sale price after commission and closing costs. So you're not going to take out your loan. So a lot of people think, well, geez, I could take my loan out, but you can't. All right. So what we're going to look at from a tax perspective, I'm going to kind of break some of this down for you guys. All right. So you have a sale price that might be 1.1 million, as I mentioned earlier, and then you're going to pay commission, closing costs, title, escrow fees. Okay, that's $100,000. Your net sales price is $1 million. All right. It's really that easy. Don't think about the loan because you don't deduct your loan to get to the net sales price for 1031 exchange purposes. My net sales price minus my basis gives me my gain. Now, what is my basis? And this is going to go into Barbara's question about improvements. All right. My basis is what I paid for the property minus my depreciation plus all my improvements. All right, so that's where your improvements get factored into your real estate. It's part of your basis. So if I went out and let's say I bought a property for, I'm going to show you my presentation here, for $500,000, and I've taken $100,000 of depreciation. I put a new roof on for $25,000. And then after commission and closing costs, my net sales price is $1 million. Well, I'm going to crunch some numbers over here, and I'm going to have a $425,000 basis. All right. Remember, purchase price minus depreciation, total depreciation, plus my new roof gives me my adjusted basis. And then very easily, I can figure out what my gain is. All right. My gain is $575. When I do an exchange, if I want to defer the taxes on that gain, how much real estate do I have to buy, guys? $1 million worth of real estate. So I'm selling for net sales price $1 million. I have to buy for $1 million or more to defer all the taxes on this gain here. And what is the tax rate? It's about 33%. So my taxes will be about $200,000 bucks. Does that make sense? All right, a couple other questions that we will get to here. For identification purposes, do I have to have an offer on the properties? Absolutely not, right? When you do an exchange on day 45, you have to identify what you're thinking about buying on day 45, but that doesn't mean you have to be in contract, okay? So all we need is that identification letter filled out. All right. For a rental property with an in-law unit, can I use the in-law unit, or is that going to disqualify my exchange? So good question. And again, I'm going to draw some pictures here because that's how I like to talk. All right. You've got a property that is a rental, and then you've got your little in-law unit here. All right. Can I use this property, or will that mess up my exchange? Well, it depends. All right. So let's talk about a 1031 exchange where you sold for $1 million. When you do an exchange, you have to buy investment property worth $1 million. So if this property is worth $1 million and it's completely rented out, you can use the little one. You can use it as much as you want. All right. The problem would be is if you sold for $1 million and you bought for exactly $1 million. Well, then you're going to have to allocate value, let's say $800,000 to this and $200,000 to this. All right. And then you can't use either of them because if you use this personally, then it's not going to count towards your exchange. Does that make sense? So you got to be careful whenever you're using 1031 exchange property because the portion you use may not then be eligible to count towards your exchange. All right, Glenn says, this is a very good question. In the conversion of an investment property to personal residence, you can use both the homeowner's exemption. Now, this gets tricky, Glenn, because there's two ways in which you can do the homeowner's exemption and the 1031. The first is when you have a primary residence. So I'm going to put primary here, and then you use it later as a rental. Okay. In this scenario, at the time of the sale, the property is a rental, so it is eligible for 1031. But you've also lived in the property for 2 of the past 5 years, so you can also take your homeowner's exemption. You can use both. Let me show you how that would work, Glenn. You sell a property for $2 million. The first thing you're going to do, if you're married, you're going to take out the homeowner's exemption amount of $500,000. That leaves you with a remaining balance of $1.5 million that needs to be towards your 1031 exchange. And as long as you do an exchange and go out and buy another $1.5 million worth of real estate, you defer all of your taxes and you're exempt on the $500,000. That is scenario number 1. Now, Glenn's question is scenario number 2. Scenario number 2 is I have a rental. And then I move into it and I make it my primary. So it's the opposite situation. Now, when I sell the property, the only tax break that I can get is the homeowner's exemption because at the time of the sale, it's not a rental. At the time of the sale, it's only a primary residence. So as long as I've lived there for at least 2 years, I can take the homeowner's exemption. The problem with this is that when you convert a rental into a primary, the government is going to prorate your gain and allocate a portion of the gain to your primary residence time, and only that gain can be sheltered under the homeowner's exemption. This is really advanced stuff. So if you're not following me, don't worry about it. It's kind of technical. I do have an article that discusses both of those situations. So Glenn, if you'd like the information in writing, I can send it over to you. All right, Julie's asking my favorite question. Actually, it's my most unfavorite question. Julie wants to know about reverse exchanges. And ladies and gentlemen, I hate reverse exchanges. And let me tell you why. Everybody wants to do a reverse exchange, but the problem is they're really tricky. A reverse exchange allows you to buy your replacement property first, and then you have 180 days to sell. And people think, oh, that's fantastic, let's do it. The problem with a reverse exchange is that you cannot own the new property and the old property at the same time. I have to become the buyer of the new property for you, and then when you sell your relinquished property, I can then transfer the new property to you. Does that make sense? So once again, ladies and gentlemen, in a reverse exchange, I'm going to buy this property. Once you sell yours, I can transfer this new property to you. So my fees are a lot higher to do a reverse exchange because I have to take title to this property for you. You're going to have a transfer tax when I take title and when you take title. So there's 2 transfer taxes. There's also 2 escrow and title fees. So these reverse exchanges can be really, really expensive. And the real problem is that they're almost impossible to finance. Because, ladies and gentlemen, Wells Fargo is not going to give you a loan for a property that I'm buying. Bank of America is not going to do it either. So they're really, really tough to finance. So yes, they are possible, but they are expensive, and they're generally done by people who have really good relationships with the banks, or they're willing to go to a private money lender and pay a lot more. All right, thanks for that question, Julie. A couple more questions, and then we're going to wrap up, ladies and gentlemen. Stephanie wants to know, can I buy land with plans to build on it later? Absolutely. So you can buy land. So you sell for $1 million, you buy land for $1 million, and then later you build on it. That's fine. What I don't want to see you do is build on it the day after you close and then move into what you built. All right. I want to see you build an investment property, or I want to see you sit on the land for 2 years or more and then build your house on it. Good question. All right. So Mark wants to know, can I identify 2 properties and then as a backup, the DST? Absolutely. So you could go to Toby today and you could say, hey, Toby, I'm in an exchange. I really want to buy something in Reno, but if I don't get it, I'd like to reserve a slice of your DST. And you can have that as a backup. So the DSTs are used a lot of times as a backup in case you don't get your first option. Yes, you can absolutely do that. All right, Glenn wants to know, if I need to exchange using debt and cash, can I do that in a DST? Absolutely. So Toby talked about that. The DSTs, they're going to have debt on them, right? So you've got a $50 million building. Half of that money is investors' down payment or equity. The other half of the property is bought using debt. So when you come in as a 2% owner, this is your little slice, you're also going to get 2% of the debt assigned to you, all right? So yes, you're going to get your debt coverage or your debt required with the DST. Okay, a couple other DST questions. Are most of your DST offerings multifamily? And I think Toby's, most of them are. We talked about Toby's fees. And I think we're going to save the rest of the questions here. I'm going to answer them. I think I've answered most of them individually. So if I'm not going to get to your question now, we're going to wrap up. Shoot me an email and I'll absolutely answer your questions. We're about 15 minutes over, so I do need to respect people's time. So thank you all very much. We look forward to working with you. We are a 1031 exchange accommodator. We want to be your partner. So when you do an exchange, you have to have an exchange company. We'd love to be that option. Obviously, Toby would be very interested in chatting with you about his products as well. Use us as a resource too. Pick our brains. When you have a client that's thinking about doing an exchange, use us, get us on a conference call. You can talk to me anytime about the rules. You can talk to Toby about what they have coming up with their inventory, and happy to be your partner going forward on all of your future 1031s. Thank you all very much, and keep an eye out in your email. You'll get a follow-up email shortly. If you didn't get a chance to download the presentation materials, they will be sent to you in an email very soon. Thank you all very much. Have a fantastic rest of your day, and please do stay safe and happy in quarantine. Take care, everyone.